While there is no doubt that the debt crisis in Europe has been the driving force behind the volatility we've seen, one market strategist says you may want to reshift your focus. It is China that may be the catalyst for a move higher into year-end. Yu-Dee Chang is the principal and chief trader at Ace Investment Strategists, and he joins us now. Yu-Dee, thanks very much for coming in. Appreciate it. What do you know, if anything, other than what we've heard about what China may be planning to do with buying these European bonds?
Yeah, absolutely. China is really stepping up to the plate to be a major player and an important member of the so-called world community. So it's good news, no doubt about it. But don't forget, they are buying these triple A-rated SF bonds, so they're not really stepping up to the plate, buying the Italian bonds or the so-called Greece bonds. So on the surface, of course, it's good news. It's not bad at all. But that alone is not going to resolve the European debt crisis. So I think that is on news. So right now, the market, if you look, no doubt, is still very much headline news driven, correct? Number one, Greece on, Greece off. From there is the Chinese growth, and then it's back to the U.S. fundamentals.
Well, before we leave Europe entirely, let's talk about how this bond purchase, or the rumors of the bond purchase, were affecting Europe. The euro itself was getting beaten down terribly in the morning. It seemed to come back a little as a result of this news. Am I right on that?
Yeah, you're absolutely correct. Not only that, if you look, the bond prices actually went down. The market rallied on it. So, again, on the surface, of course, it's good news, right? Not only the European leaders are coming together and showing some resolve, finally trying to resolve their debt crisis. Even China is stepping up to the plate, saying that, hey, you know what? We're willing to chip in and help on our end. That is good news to the European
Worst case scenario, if there is a recession in Europe, how does that affect China?
Yeah, it does affect China, no doubt about it, because China is very much an exporting country. But overall speaking, if you look, the world is basically divided into three zones. U.S. is actually has stabilized, and little by little, it's actually start to going upwards. Europe is going through what we have gone through back in 2008. Even if they resolve the debt crisis, they're still going to take a while before they get back to their economic growth. China, though, on the other hand, despite all the data we're seeing, it is still growing. Not only is growing, if you look at the third-line cities, I think the growth is going to be there for many years to come. So China, I think, will lead the world out of this so-called recession and start to growth.
So how does all this affect the United States right now? You say, from what you're saying, it sounds like we're a little insulated from all this craziness.
Well, not that we're insulated. I think we're pretty much right in the middle of these things. However, I think looking strictly at the U.S., we have stabilized. While we may not experience a very robust growth, I definitely don't think we'll be double dipping. So U.S., I think, is stabilized. But I think the driving engine of the globe, of the world, still is going to be these developing countries, such as China, India, Colombia, for that matter.
Yeah, well, Yu-Dee, I love you because you're not only good for the macro, you're good for the micro, too. A couple of big-name stocks that you like right now: Coke, Johnson & Johnson, J&J, and ConocoPhillips. Why the big names?
Yeah, the big names. Two things, right? Number one, look at what it has been doing despite of the turmoil, amidst the turmoil. Number one. Number two, Johnson & Johnson. Not only every single American household needs Johnson & Johnson, even the Chinese household now start to buy Johnson & Johnson. This is regardless whether we're going to be in recession, not recession, European debt crisis, you need Johnson & Johnson. McDonald's is actually very much poised to start to expand in these developing countries. And look at the price action right now. And also with their earnings growth and with their dividend rate about 3%. Growing at 9%. That's why I like these stocks.
I was going to remind you of those dividends. That's a nice little addition. Yu-Dee, wonderful to see you again. Please come back and see us soon. Yu-Dee Chang, thanks very much.
Thank you.
Well, amid growing concerns